Welcome and good evening to your financial journey, the January investor update. And it's funny, I've been talking with people over the last few weeks, I guess pre-Christmas, between Thanksgiving and Christmas, and there's been a lot of people who have been asking for an update on the markets and everything. I had actually thought we were going to be able to get away from that a little bit and maybe start doing some more teaching on some of the principles we work with. But I think as we've finished out the year here, and maybe even days like today, cause people to wonder, should they be concerned? If so, why or how, or what would we do to be more proactive or reactive if necessary? And so, as many of you requested, I put together information, putting together information on market updates, as well as bring a couple other pieces to the discussion today to help you figure out how to go forward this year with what we're doing. So hopefully tonight is going to answer some questions for you, and you're going to feel pretty good by the time we're finished here, because quite honestly, I feel pretty good, even with some challenges we've seen today. So let me take a minute here and just kind of remind you of some of the issues we have to deal with, the important disclosures. As always, my encouragement to you is recognize that everything we look at is probability based. Unless it has guarantees or riders or protections built into it, we are trying our best to look at statistical models and make great decisions from those. If there's anything that we talk about that has tax implications or legal implications, as always, our encouragement is that you should talk with your accountant, your attorney, anybody who could help as part of your financial team, of which I am honored to be part of that, to help you figure out how to make the most of what you have and to make it grow, and then how to protect and preserve it as we strive to create wealth. There will be a time for questions here at the end, and as you'll see here in a little bit, we have a special guest that I asked to come on and talk about an additional item that I'm very excited about and what we can do and utilize here to help you grow wealth and protect and preserve it. So you'll have a chance for questions. Feel free to raise your hand or to use the chat box, and you can put your questions in there, and then we will be happy to go over those. Tonight, we're going to take a look at 2021, just to kind of get a feel for where we've been. Take a look at some 2022 expectations. Special guest we have on tonight is Eric with Private Shares. He's going to be sharing some private business opportunities that I think may really add to some of your portfolios based upon what you're trying to do. And matter of fact, I've even had a couple of conversations today with clients about this potential opportunity. So I'm looking forward to letting Eric share tonight here. We're also going to take a look at, as a reminder, the 8 asset groups and our 10 investment concepts, the wealth management apps, take time for your questions, and then remind you of the next investor update. So let's start here with this and take a look at what the review was for the year previously, 2021. The Dow was up about 18.7%. The S&P 500 was up 26.9%, and NASDAQ was up 21.4%. We're going to take a look at the charts for that just here in a second. We're also taking a look at corporate bonds, because I know that some people think that, well, if we're going to get safe, we got to take a look at bonds. And so maybe that would be a solution for some. I don't think so. But again, if that's a question or a thought for you, I'll be happy to spend more detail on that. But we are going to at least touch on it tonight. So let me go ahead and minimize this for a second, and then go take a look at a couple of the charts here. Look, there's me. All right, so let's go ahead and take a look at the Dow. Now, again, as I mentioned before, we had an 18% return in the Dow. Not too bad. That's pretty good as far as things go, but you'll notice there was a fair amount of volatility. This is taking a look at the Dow going from, thought we set that up for a year. Oh, somehow that did not get set up properly. Let me check quickly, adjust that. Technology, it's been one of those days all day long. Let's see, is it right now? Yes, that's right. Okay, so here's taking a look at the Dow going back from January 1st to now, and taking a look at performance. We can see how the year has worked. There has been a fair amount of volatility in it. Kind of flattened out a bit during the summertime, as you can tell. The highs and the lows continued to climb until we got into May. Then they kind of flattened out a bit, And then again, we went into the last part of the year as of November, kind of looked like it was going to take off again, slowed down, ran down into that 200-day moving average, bounced up, came back down, tested again, and into the year right about here, which is that 18% return that we were talking about. Not a bad year. Can that happen again this coming year? We're going to talk about some of that tonight. Let's take a look at the S&P 500. Make sure that's set up properly. Yep, okay. So again, you'll see that while it had a very nice run up, it really did not stall out much during the summer. The S&P continued to do well. It did run into a little bit of problem there in October, that bewitching kind of month, took off again, kind of got flat, and then took off again towards the end of the year. The S&P 500 being a much broader index than, say, the Dow 30, and it kind of gave a little better opportunity. I think we were close to 27% for its performance this year. Again, not so much in the volatility, and I would point out that it barely ran into the 50-day moving average. Every time it ran into that 50-day moving average, it continued to bounce back up, except here in September. Then it kind of flattened out, kind of worked through some things, then took off and continued that path. Will it continue into 2022? We're going to talk about that as well. And now let's take a look at the NASDAQ. Make sure that's set up properly. It is. So we can tell the NASDAQ, which is pretty tech heavy, had a little more volatility to it. Certainly kind of took off right again at the beginning of the year. You'll note that it hit a high there in February, dropped, came back up. It's still, if you follow the line, the horizontal line across, you'll see that it bounced up, took that same ceiling, and then turned around and headed back down again, came back up in June, and then broke through the resistance, continued on up, tested the 50-day moving average, never really got down to the 200-day moving average, continued on, but you'll note that while it hit a high in November, it did turn down and then never quite got back up to that to the end of the year. Still, having said that, it was a 21% return, not a bad year. And how's it going to fare this year? Well, we're going to talk about that here in just a moment. This is for those of you who think about bonds and wonder if bonds might be the best choice for you, looking here again for the year, going back to January and carrying it forth to the end of the year. We can see that bonds, if this is where we started in the year, we can see they actually finished down for the year. There were a couple of points where they came back up, and I think that had to do with interest rate concerns, etc., what that might do. But in the end, they really did not perform well. And again, since interest rates are so low, they're not really one of our favorite places to go right now. We're tending to use, for those of you who are looking for cash positions and more conservative, we're tending to use interval funds. You're looking at either credit or legacy real estate programs to produce 5 and 6% yields with having a more stable kind of approach than we think bonds will provide. And especially if interest rates start to rise, I think we would see these bonds fall even more aggressively. So having that in mind, even though bonds certainly would be one of the circles that we talk about, I don't think it's a circle that we're focused on much at this point in time. So for now, we're really kind of staying away from those as being our places to go and looking more at some of the stock indexes, some of the various industries, some of the real estate plays, and again, some things that we're going to talk about tonight regarding private shares and how that might help as well. Now, as we move forward, I want to talk about this chart, but I'm going to set this aside for just a minute and come back to it to make sure that we have a good understanding of where things are headed and what we kind of expect to happen. So let's talk about something that's kind of heavy on everybody's mind, which is inflation. So one of the charts that I follow is right here, actually comes from biz.gov. This is right there from the US Bureau of Labor Statistics. Find it to be a very interesting chart to kind of get a good understanding of what's going on here. And I know you've heard lots of information about the inflation and where it's at. You'll note on the chart here, we're looking at upwards of 10%. This is going back December of 2001, and this is December of 2003. So it's moving forward in 2-year increments to, here we are, to the end of this year, December 2021. And so what we're looking at here is all items, meaning that we're looking at all items here listed above. You'll see in a second, I'll break this out. and we can see where inflation is. And at this point in time, 7%, which if you've been listening to the news, that doesn't surprise you. That's what you've been hearing. But if we want to break it down and take a look in a little more detail, so for instance, let's say we want to take a look at gasoline and put that on the chart as well. So now you can see, so here we are with that all items, but here we are with gasoline. And as I said to somebody today, we're looking at almost a 50% increase on gasoline costs. And if you've been going to the pump, you realize that's true. One thing I didn't mention before is you'll see here these gray areas. These gray areas are recessions. And so you can see that this is the Great Recession in February and December of 2007 up to about 2009. And then this is the pandemic right here, March, which was a very short-lived recession. We can see though with fuel prices, with gasoline, we can see that, for instance, this high here back in 2010 is roughly close to, matter of fact, a little higher than where we are today. And so one of the questions that I have as I look at energy as being one of the industries that we think has a lot of upside still, will gasoline prices hit those highs again? Will oil prices hit those highs again? So let's compare it now to energy and add energy into the mix. And if we put energy in the mix, we can see that here's fuel, gasoline, and then here's energy. So energy costs have gone up, gasoline has gone up even more. And I think, quite honestly, we might see some more here by the time we get to the summer. Let's take gasoline back out. From a pure investment play for an energy or for an industry, we can see that energy has done pretty well. And I think that it's probably going to continue to do well. Matter of fact, if we take it back to here's now at 29.3, and we go back here to 2008, it's at the same place. The question is, where's it going to go from here? I think that with supply and demand issues, which we're going to talk about also, I think that probably it's going to go higher, because I think that probably our demand need is going to continue to increase as we get past COVID and some of the other issues. And I think that as that happens and the supply chain begins to repair itself, as I think probably we see examples where it is doing that, people will start moving around more, they'll need more gasoline, they'll need more energy, and yet I don't think the supply is there to meet all that at this point. So I think that'll be one issue. Let's take a look at some other issues you might be interested in. Here is food at home. You can see how food at home has compared, for instance, to say overall inflation, 7% for everything, 6.5% for food. Take a look at shelter. We don't want the chart to get too busy. So we can see that shelter has gone up, but not quite as much, which was surprising, I would say. I had expected it would be a much higher incline by now, but it hasn't shown that yet. Take a look at new vehicles. New vehicles have gone through the roof. They're at 11.8 compared to everything else at 7%. So we're seeing that as being an issue. If we look at services, not including energy, we see that services have not gone up. There's been some price compression in how people provide services. How about medical services? What are we seeing there with medical services? Surprising, isn't it, that medical services haven't gone up as much? I kind of wonder sometimes if that's not because of the government holding prices down and how they're handling the reporting of COVID versus other ailments. But again, it's kind of hard to say that with any certainty, but it is something that I would wonder about. Let's see, what else was I going to look at for you? Electricity. So electricity has kind of compared pretty well to what we find the overall categories have done. So with this recent upsurge, let's get rid of electricity now, and we see how inflation has behaved here, and then we take a look at it going back to say 2008. You know as well as I do, you go back to the 1970s, you're looking at overall 10% inflation. So when we look at that, we see that we have a definite inflation issue, and as we've talked before, what percentage of that is transitory and what percentage of that is permanent? And again, I was visiting with somebody today, we were talking about transitory. What does transitory mean? Well, it just means that it's in the process, but if you stop for a moment, what it really means is that with supply chain issues, supply and demand, it's actually throwing inflation up a bit because of supply being less due to various issues, whether it's chips not being available or certain resins or certain packages not being available. It's throwing that supply chain off, but demand is still up there, and so it's forcing prices to go up. But once those prices, once there's a great supply, more supply than demand, that's going to force some of these prices back down again. Why? Because of competition. And that's really what it comes down to, is that as there becomes more supply and one group or company or individual wants to sell, if they can still make a profit but reduce the price a bit, it forces the pricing down, making it so that the transitory inflation can begin to pull back. Again, why? Because of competition. And so will competition take over as we go through the year? I tend to think it will. As I have said to many of you, if tomorrow or tonight they came on television and the administration and the mainstream media came on and said, COVID is done, we don't have a problem anymore, everything is fine, I think you would see the economy take off in a big way, because quite honestly, people want to go do stuff. They're sort of tired of not being able to do things. They want to be able to go enjoy life a bit. And so if they go out and do more, that means there's going to be more travel, more restaurants, more hotel stays. There's going to be more things that are purchased. And honestly, as people feel comfortable to go back to work, which labor shortages have been part of the challenges we face, that would begin to open up too. At least we think it would. I guess it depends if the government, state governments, federal government get out of the way and let the private marketplace hire people and make it so that they don't have reasons to stay home rather than go out and work. Now, with all this inflation, because this is what reason I really pulled this up, with all this inflation, you would assume that there would be some improvement in things like commodities and precious metals and so on. But that's not the case. As a matter of fact, this is gold using an ETF, Spider Gold shares. You would assume with all this inflation, and this is just for the rate here, this is 2019, here's 2020, 2021, here we are into 2022. You would assume that with all this inflation, the gold would be taking off. But as you can tell, the highs are getting lower as well as the lows are getting lower. And even though we have this little bump up here, it did move back up again. It kind of matched, it hit its ceiling and turned around and headed back south again right here. The highs are not any better, and the lows, quite honestly, are only improving slightly. So with all this inflation, you would think, well, maybe something like gold or silver would really take off, but it hasn't yet. It hasn't had that big bump up that we would sort of expect. Some might say, well, but what about Bitcoin? Maybe Bitcoin is taking the oxygen out of gold. Maybe that's part of what this is. So this is Bitcoin going back as compared to the US dollar, and you can see where it's hit its highs. You'll notice that it recently hit another high, but that high was not that far off from its previous high, which is back in March of 2021. It hit it again here in November of 2021, turned around and headed south and broke through the 200-day moving average. Again, you would say, well, if inflation is the permanent issue and it looks like it's not going away anytime soon, you would think that some of these items would really show that, because these would be great hedges against inflation. But maybe what's really happening is that it's the stock market that's actually acting like the hedge against inflation. Maybe when we look at the market performance, we see the huge inflow of money into the markets that make it so that people can put money in and take money back out, and they're almost leveraging the value of the US dollar, for instance, against the stock market, which now, if you begin to put all that together, you start to think, well, so what would have to happen to slow this down? And at this point in time, what we'd look at is we'd look at the money flow, the M1 money flow, which basically what this is looking at is it's looking at US Treasury currency outside the US Treasury, I'm sorry. It's looking at depository institutions, demand notes, commercial banks. It's looking at cash, and it's not including things like liquid deposits, or I'm sorry, IRAs and cash and those kind of accounts. It's just looking at what is actually liquid. And you can see that we've had a continued increase in money flow, especially since 2020. Now, on one hand, I know for many of you, me included, it's a little frightening to see this much money flow going into the economy because we know where it's coming from. It's being printed. And there's a concern about what this is going to do as the day comes where interest rates rise and we have to pay that off. And I agree, that is definitely something that we need to be watching for. But it appears, back to my point about gold and even crypto, it doesn't appear to be the biggest concern right now. And so what I think is happening is when you have money flowing in to any asset group, whether it's coconuts, or it's gold, or it's real estate, or it is the stock market, that money flowing into it is part of what's keeping everything elevated. Now, if money flow starts to tighten up, that would be one of the big concerns that we would watch. When the Fed starts talking about raising interest rates, we can see days where the market reacts and is sort of negative to it because it perceives that's a tightening of the money flow and the velocity of money. But until they do that in a serious way, it's probably not going to stop this too much. Now, does that mean it couldn't happen this quarter or this year? No, it could happen this quarter, this year. But at this point in time, we don't really have a basis for it other than Fed Chairman Powell talking about how he knows we need to. I think honestly should have probably started raising rates last year, but they didn't. And I think it's going to be a little harder for them to raise rates this year because of the elections and concerns about what that might do. But outside of that, I think realistically, he's probably going to raise rates, whether it's a quarter of a point or a half a percentage point, but it probably is going to have to happen. And then what we'll do is watch whether there is a long-term or a short-term reaction by the markets to that. Now, with that, here we are at the interest rates. And again, just so you know, these gray bars all represent recessions. We're going back here to 1950. And so you can see where interest rates were. You can see that at one point here, this is, for those of you who remember this, 1981, we were at 14% interest. While that was terrible for borrowing money to buy a house or to build a business, it was awesome for CDs that you could get very high rates and lock it in for long periods of time. That's kind of disappeared and has continued to go on down. And quite honestly, since about 2008, we've had pretty low rates. We did have a bump up here trying to reset the economy again, but then with COVID, we've pulled back and now we're at these very low interest rates. So very likely we are going to have to see interest rates increase. It just makes sense. But whether or not it's going to be problematic or not, you can tell we've got a ways we can go here. Back in 2019, we're up to 3%. And so quite honestly, we could probably stand a little bit here. Will the markets react terrible to that? They might, but I don't really think so. I think they're going to recognize that that is probably a decent sign. So you imagine if the economy is moving faster, people feel more confident with COVID and what's happening there, and then interest rates rise a little bit, they might perceive that as a good thing, not a bad thing. Even if the initial reaction is, oh, this is scary. But overall, I don't think that's going to be a big issue right now. So with that in mind, we're still expecting to see the markets continue to do well. We're still continuing to see whether it's the broad indexes or various industries we're currently using continue to do well. And so we're staying fully invested with that. And I was just doing some research here prior to this meeting, talking about what are sort of the general consensus out there among analysts and those who play the markets regularly, and it's still very bullish. As a matter of fact, when I look at this particular measurement here, which is the New York Stock Exchange Bullish Percent Index, and we're going back 5 years, you can tell that, so this is back in 2017, here we are in 2018, and I don't know if you remember, but in the fourth quarter of 2018, the market took a real tumble, went down quite a bit, and then came right back up and held its own there in January and February and took off again, kind of held flat now. And again, this is an indicator for what people think is bullish or not. So the higher it is, the more bullish they are, the lower it is, the more bearish they are. So here's the pandemic You see how far down that went. And again, there was huge concern back then about what kind of recession might come out of this. But as you saw from that one gray line, it's pretty thin. Not much of a recession. And we have gone quite a while without a recession. So we're going to be looking at what would it take to make that happen. Here's the high coming out of the pandemic, or not out of it, I guess. It's supposed to be when we came out of it. We still haven't yet, but one of these days we might. But you can see this is where the economy kind of came back, dipped down a bit, came back up again, and it's been messing around down here. It's down below that 200-day moving average, but you can tell it's running up and it's testing it. I think at some point here, unless something bad happens, it's probably going to break through it and then probably head above again somewhere in this area up in here. That's not a guarantee, but it is, I think, a reasonable expectation. If we look at the VIX, which is a 90-day window on what commodities traders think is happening, we can see again, when you're high on the VIX, it means there's really expectation the economy is going to be terrible. This is March of 2020, pandemic, full on, just starting out there. Everybody's afraid of it. It's continued on down, on down. It did get down here. It has broken above its resistance here just recently, but continued to head on down, and now it's still flattening out. So is the VIX an indicator of a problem? Probably not yet. Probably not yet, but is something that we watch and make decisions on as we go forward. So now let me head back to this chart here. Where are you at here? I think it's here. Yeah. Okay, so with this in mind, how does this all fare for you when it comes to your portfolio and managing and everything that you're trying to do here? How does this fare? Well, you'll notice from last month to this month, everything is still positive, and this is just comparing industry to industry, except for communication services, which just went a little negative. Curious to see what that looks like over the next couple of months, but it's the first thing that's actually gone negative in this chart. Everything in this chart has been positive, positive, positive until just this last bit right here. So we look at communication services, one of those issues, but hang on a second, we'll come back to that. Certainly you can see energy has done incredibly well. We can see financials have done well, real estate has done well, and this is looking back over 200-day windows. Healthcare has started to show itself again, which is one of the things we were hoping for. Technology is continuing to hold its own a bit. These are all areas that we've been watching carefully. If we compare it to the S&P 500, we find that discretionary spending, which is buying the things we don't have to, consumers doing that. We were laughing about that today with a client. This is money they don't have to spend, but they want to. Again, communication services compared to the S&P 500 has done poorly. Technology has done better than the S&P. Industrials and materials, which I think has a lot to do with us building back our country, getting our manufacturing up and getting our supply chain working. Those have underperformed the S&P 500, but I think these are things that will come back as we move forward into this year. Energy has continued to do well. We look at staples, the things that people have to have, just barely a negative here. Look at healthcare, which has been positive most recently compared to the S&P 500. Utilities are down, but financials and real estate are still positive. When we look at these groups, and let's now take it back away from the S&P 500, and we compare it below, looking at the sector rotation model. Again, as I've shared with you before, these industries as compared to the recession itself, this is where people tend to invest when we're going into recession. And then as we come out of recession, we begin to strengthen over into these areas. And then as we hit the top of the recession and begin to turn back down again, these are the areas we work, and then it cycles back around, and here it is again. Comparatively with the markets, we would see that the market is lagging behind in this case because it's watching what's going on in the economy. It's trying to anticipate, but it's recognizing which areas are going to go. So if we were to look at these items here that have done well, we find again energy right here sort of at the top of the market, meaning that things could go south, but simultaneously we find real estate and financials clear over here, so maybe they're in a position that they could take off again. Certainly with all the money being printed and flowing through the economy, that could have a lot of strength. We also take a look over here at technology, which is on the other side of this. If you think of these and these together, you can see ourselves coming back into this piece. So again, because of the pandemic, things have been thrown off. But I would say, as I look at a lot of the indicators right now, I think that staying bullish makes a lot of sense, even if it seems a little mixed up a bit at this point on the sector rotation. Overall, the industries are doing pretty well, and I think that they will do even better as we open up with the country and things become more conducive with a good business environment, people getting back to work, people enjoying life a little bit more. So that's my overall consensus. Let me go back to, or make sure I didn't miss anything. I don't think I did. So we've covered the various issues here that I think are sort of imperative for this conversation. We can build on this if we want to go forward. But I would remind you that with our technical analysis, number 8, that we're always being proactive whenever possible and reactive whenever necessary. Just like when the pandemic hit, we made decisions to pull back quickly. And when we thought the opportunities were there, we made decisions to move back into those positions. Again, I would tell you that when things change, which we know they will, we're ready to do exactly the same thing again. So as we look at the various pieces, and I know this was very quick, just trying to give you some understanding what we're seeing with inflation, why we think that inflation isn't quite as bad as it seems. I mean, I know it's bad from a living viewpoint, but from an impact upon the markets and the economy, I think that precious metals and crypto would be showing something different if they were really going to be those inflation hedges. Money flow still continues to be what's driving a lot of this, and as long as that stays strong, I think this is going to continue to have a high bullish percent index and a low volatility index. And then when we look at the analysis for the S&P as well as the other indexes, I feel like it's leading us to say we stay invested according to your risk tolerance and make adjustments only as new information comes forward. Which now brings me to this last piece, additional strategies, because we're always looking for new ways to maximize your return to create, grow, protect, and preserve wealth. And as I've shared with you countless times before, we have the 8 circles that we work off of, the 8 peaks, if you will: cash reserve, money for flexibility and emergencies and opportunities; bonds, typically for loanership assets to give us interest and give us some growth, some stability, I mean, if we need access to a more stabilized environment. Again, I don't think that fits so well right now with interest rates like they are, but something we would want to do at some point in the future when interest rates have gone up. Equities, or the stock market, representing businesses, roughly 6,500 in the country that we can invest in, giving us great business growth opportunities, but also subjecting us to market risk, which is one of the issues why we take a look at some other alternatives. Real estate, also an ownership asset, gives us the ability to own buildings where people live or where companies are housed, whether we do it individually or in pools. Tangible assets, items like energy, gold or precious metals, commodities, etc. Currency, and I'm going to talk more about the strengthening and weakening dollar circumstances in our next update. Business interests, as I've said before, there's about 6,500 companies over here we can invest in. There's 2 million private companies that we can invest in. And one of the reasons I've asked Eric to be on here tonight is to talk about some opportunities that will give us the ability to have growth, to have a return in our accounts, and to maybe have some stability where we're only just dealing with business risk, not market risk. And then finally, insurance and annuities, which basically are mirrors of any of these, but they have guarantees or riders or stabilizers in them to give us protection for that. So with that in mind, I'm going to turn it over to Eric Noto. He is a gentleman we've been working with now for a while. Eric and I have talked several times now, and I really wanted him to be on this call today to share with you what Private Shares is doing as a way to invest in that circle about business development. Not the stock market, not where the 6,500 are, but access to opportunities in the companies where I said there's 2 million, a way to have the growth we want and some stabilizing as well. Eric, are you on here?
I am here, Frank. Can you hear me?
I can. Let me go ahead and make you a presenter so you can share your material with us.
Great, thank you. All right. Can you
Yes.
see that?
It's
okay,
small.
Great.
Yes. And if you want to share Want to share your camera too? I don't know if you can or not, but if you want to, you
Yes,
can.
absolutely. Let me see here.
Yep, there you are.
All right. Well, hello everyone. Again, my name is Eric Noto, and like Frank said, we've known each other for quite some time now, and I'll be talking a little bit more, as he mentioned, about the private shares fund. First and foremost, Frank, I appreciate you obviously inviting me to tonight's event. I enjoyed hearing your thorough market analysis. I even jotted a few thoughts down and agree with a lot of what you shared as far as operating and investing in, I think, a peculiar and an interesting market, a lot of which is tied to where interest rates have been now over the last decade, and some of the challenges maybe that does maybe dictate over the next coming year or the next 5 to 10 years, right? It's certainly where you look at where equity valuations stand, across pretty much every metric, they are a little bit frothy in conjunction with, where yield stands in the traditional bond market. It is certainly difficult to generate a real rate of return, and there are challenges with that. So because of that, I think that this is where the private shares fund has generated, I'll say, a decent amount of interest amongst financial advisors like Frank in looking for alternatives, right? In looking for non-correlated asset classes, right? That can not only help smooth out returns, but hopefully in tumultuous market environments actually provide returns. And so with that, again, I'll be talking a little bit more about the private shares fund, which is really just a 40-act interval fund. And it sounds like, Frank, you and your clients are obviously familiar with the interval fund structure, but it's an interval fund that invests in private companies. And for us, it really helps, in our minds, it really helps solve two of the more traditional issues surrounding the ability for an advisor to invest in private companies. The first is access, right? As I'm sure many of you are aware, as Frank kind of shared with me, historically, for one to invest in a private company, you had to be an accredited investor, right? You had to be a qualified purchaser, you had to be an institutional manager. So what differentiates the private shares fund is that it allows both accredited, but most importantly, unaccredited investors finally the ability to access private companies, companies like SpaceX, companies like Masterclass. This fund's been around since 2014 and has bought into companies that I'm sure all of you are very familiar with, such as Uber, right? Or Spotify, right? A music streaming service. And we bought into these firms years before they went through an exit. And so not only does it provide access to these companies for unaccredited investors, but secondly, and I would argue maybe most importantly, at least from the conversations I've had with financial advisors, it simplifies it, right? The structure of the interval fund simplifies the way in which accredited and unaccredited investors can buy into these companies. So what do I mean by that? Well, in conjunction without having those accreditation requirements, Frank and yourself, if you do believe in investing in this fund adds value to your portfolio, you do not have to fill out a 50 or 60-page subscription document package that typically is associated with the traditional limited partnership structure of investing in private companies. There isn't a $250,000 minimum, or in some cases $1 million minimum in this fund, right? It's a $2,500 minimum. Your capital, right, is not going to be locked up for 5, in some cases 10 years, right? We offer, just like any other interval fund, quarterly redemptions, right? There's no performance fees, right? There's no carried interest that are typically associated with limited partnerships. And I think most importantly, for someone like yourself who's interested in looking at this fund, you know exactly what you own, right? And let me just, there we go. Can you see that? I just want to make sure, Frank, that moved on your screen as well.
Yes, it did.
Okay, great. So there's a level of transparency here, right? As far as again, exactly what you own. And these are our holdings as of September 30th of 2021. I was hoping that by the time that we did this tonight, that our Q4 deck would be approved, but sometimes compliance takes a little bit longer than we all would like, but that's okay. And our hope here is that you recognize a number of these names, many of which you may be familiar with and may have thought that, because you're familiar with them, they are already public. But that's not really the case. And so, we're in names like SpaceX, we're in names like Masterclass, and I will touch on some of these companies a little bit later. But when you think about why do we believe that everyone should have a sleeve inside of the private markets, and I think I emphasize a sleeve, meaning around 5%. We don't look at this as a core, but we look at this as a small sleeve given the environment. It really stems from what has transpired over the course of the last 15 to 30 years, both within the public, but of course the private markets. And Frank kind of touched on this, but on the public side, right, you've actually seen the number of public securities cut in half, right? I think Frank said it's around 6,500. I agree with him, but 30 years ago it was actually north of 12,000, right? And so on one side, you've seen the number of public securities cut in half. You've seen a tremendous level of capital flow into much fewer securities. And so on one side, you could argue that it's become a much more efficient marketplace. Whereas on the opposite side, the number of private companies, right, has grown tremendously. And this is a chart that just simply looks at private companies that have over a $1 billion market cap. In our world, we call those unicorns. Well, 10 years ago, a little over 10 years ago now, there was one. And I'm sure everyone on this call is familiar with that one. It was Facebook, right? Today, there's now over 800 million. And so when you think about what has really led to the underlying growth of just the sheer number of private companies, right, that we can invest in, it's really driven by the common theme that the average company today is just simply staying private for longer. And there's a couple different reasons for this phenomenon as far as why are companies staying private for longer. Well, one, it has become extremely burdensome to be a public company. It's become a massive administrative burden. It's very expensive as well. Secondly, when you think about a company, right, a private company is in what we kind of call the hyper growth phase, right? And when you become a public company, I think you start making decisions that are based on beating quarterly earnings estimates, right? You're really making decisions based on the short term, as opposed to making decisions that are more going to be impactful for a company over a longer cycle, over a longer term, right? And then lastly, and most importantly, the amount of capital that's been made readily available for these private companies to tap into, right, has grown exponentially over the course of the last 20 years, meaning that 20 years ago, take the likes of an Apple or Amazon or Cisco Systems. A lot of companies, I'm sure you folks may have been invested in the past. Many companies were almost forced to go public in order to raise a certain amount of capital to finance future growth. Today, companies of those profiles can stay private because they can access capital through the private markets. And so that's exactly what this chart shows, right? So 20 years ago, from a time a company started to went public was 4 years. And when they exited, they went public at less than a $500 million market cap. Today, it's now taking about 12 years for a company to start to go public. And when they are exiting, right, they're exiting north of a $4.3 billion market cap. So what does that mean for investors? Well, 20 years ago, right, you could have invested in the Apples, in the Amazons, in the Cisco Systems, and participated in the exponential growth of those companies that say went from a small cap to a mid cap to a large cap company. Today, because companies are staying private for longer, the bulk of that growth, and therefore in turn, the bulk of those returns are actually taking place in the private markets. However, it has been, again, extremely difficult for the average investor to get exposure, to get access to those companies. So I think one of the unique structures, one of the unique aspects of the private shares fund is it again democratizes the way in which it allows all investors to access these companies years before they go public. But again, it hopefully it eliminates a lot of the headaches that have been more traditionally associated with investing in these companies through the limited partnership structure. Frank, anything there you want me to clarify? Any questions you think that come out of that? Otherwise, I'm happy to kind of continue with a little bit more about the fund itself.
No, I'd say go ahead and go with the fund itself. I appreciate what you're sharing.
Yeah, absolutely. So what are we buying, right? What types of companies are we looking to invest in? Because there's a lot of different types of private companies out there, right? There's startups, there's what we call mid-stage, and then again, there is late-stage companies, right? So this fund entirely focuses on late-stage venture-backed private companies, right? Now, how do we quantify that? How do we qualify what is late-stage relative to what's mid-stage? So we are basically looking for companies that are generating, at minimum on an annual basis, $50 to $100 million in revenue, again, on an annual basis. We are looking for companies that are basically growing their top line revenue at least 30 to 50% on an annual basis, right? Something else that we really emphasize is that we want to see what we qualify as an anchor venture capital firm already invested in this company, right? So when we say an anchor VC firm, there's a couple that we point to, right? Some of you may be familiar with like a Sequoia Capital, right? Or an Institutional Venture Partners, or a Kleiner Perkins, or an Andreessen Horowitz's. These are some of the most established venture capital firms out there that have the capital to, of course, get behind these companies while they are private and help guide them and take them through an exit. So the idea is, if you're playing in the same sandbox, right, as some of these, most qualified VC firms out there, that typically your experience, typically your investment, your returns are probably going to look better through the cycle than if you wouldn't happen to see one of these VC firms. And then lastly, what we really look for is basically, will these companies have an exit in a 2 to 4 year window, right? So again, we are trying to buy these companies a few years before they say go public, or maybe they get bought out via an M&A deal, right? And so if these boxes can get checked, right? Okay, this is late stage. Again, that 50 to 100 million annual revenue, 30 to 50% top line growth. We see a Sequoia Capital or an established venture capital firm on the table there. Then we say, okay, we're interested, right? And then the next step is really where most of our homework, if you will, and time is being spent. We typically then try to comb through the company. We have to sign a non-disclosure agreement, and this is where we typically get all the financials. And without going into too much detail, we're looking at historic financials. We're looking at present financials. We're looking at forecasted financials. We're looking at cash flow of these companies. We're looking at competitors. Again, we're looking at, all right, who's already invested into this company? And really what we're trying to garner here is the profitability of the company. And from an analysis standpoint, when you're investing in private companies, what you're really trying to do is model out the exit valuation, meaning what do we think this company is going to IPO at? Or if another asset comes in, like a Google or Facebook, and buys this company, what do you think they might be willing to pay for it? Because the exit valuation justifies the price that our investment team is willing to pay. So let me give you kind of a tangible example of that. If we run through our exit valuation, right, and we realize, okay, it's going to take $10 per share for us to get invested in this company, right? And we realize that to generate $1 of return on that $10 investment, that this company needs to exit at $6 billion. And when we run through our exit valuation, we realize that we believe that this company is only going to exit at $4 billion. It doesn't matter how great the company is or how excited we are about the company, we're going to pass on the deal, right? And we did this over the course of the last year with some pretty predominant names that I'm sure everyone on this call is probably familiar with. One being Airbnb, the second being DoorDash. And so we got calls from clients saying, well, why weren't you guys in Airbnb? And it's us saying, look, it's not that if we don't love Airbnb and don't love their business model, but a huge part of what we do is making sure that we don't overpay for assets, right? And so that's critical to every single company that we look at, is that we want to make sure that the dollar we invest today is going to lead to a 2 to 4x return over the course of that company going through their exit. So that's a big part of kind of the way that we look at investing in the private markets. It has to make sense from a valuation standpoint. Frank, again, just want to stop there. Any questions there? I don't know if anyone has submitted any questions, but I want to make sure if anyone does have any questions, we of course address that.
Sure. No, there aren't any questions so far, but I do. If you could go back to the upside down pyramid there.
Yep.
And you were talking about, so in essence, we're starting at the top or starting at the bottom. So somebody watching that.
Yeah, so we play in the universe of private companies, right? And there's a lot of different types of private companies. One of the first things, again, we do look at is, okay, we are really looking at, and I kind of think that the VC late stage tends to get commingled sometimes, because typically the types of VC investors we're looking to co-invest alongside of really only play within late stage private equity, right? And so we are looking for private companies, late stage private companies that are VC backed, right? And then it's a matter of, if we can get access to these companies, right? Then we start going through the evaluation process. And once we are comfortable with the price at which we need to pay to invest in those private companies, then goes to the actual investment.
And when you invest, how much do you typically try to invest in these companies?
Yes, great question. So typically we initiate positions between 1% to 3%, starting within the portfolio, right? So right now, our fund's a little bit north of 700 million. So typically we'll initiate positions anywhere right now, usually between 10 to about $20 million is typically what we're looking for. And it actually brings me to kind of the next point, Frank, and I know you and I have talked about this, at length, is, we're excited about where we are with this fund, because we can now start really cutting pretty substantial checks to get into better caliber companies. Because the reality is that to get into a SpaceX, right, to get into an Uber a couple years ago, you have to be able to cut at minimum, usually about a $10 to $30 million check per transaction. Otherwise, a lot of those companies will say, hey, we appreciate your interest, but we'll let you know if there's anything left. Well, as you can imagine, the most sought after private companies, there's a lot of people that are trying to get invested into them. So again, you're really not going to get exposure unless you can cut that check. So we've always kind of believed that with this fund, as we've continued to grow, and as we've continued to be able to cut a larger check size, it has absolutely evolved the way in which our investment team sources its deals, from taking capital and investing directly into a company, what's called a primary financing round. So SpaceX goes out and raises a couple $100 million, right? We are taking, capital that we have raised, and we are investing it directly into these private companies. So that excites us, right? Because in our mind, the better companies that you get into, the better terms that you're investing into these private companies, ultimately leads to a better return profile for investors. And I really think you started to see that manifest itself in the last couple of years. Last year, of course, netting 24%. The year before that, obviously generating about a little over 23.5% for investors. So, what we're really trying to invest in here is we are trying to really build out a diversified portfolio of innovative and disruptive technology companies across a variety of different sectors, whether if that's aerospace, whether if that's cybersecurity, whether if that's data analytics, right? We kind of joke, big data is big business, right? It's driving a lot of advertisement campaigns and marketing campaigns. And so that is the goal. And there's a couple companies on here that I would love to just really quickly touch on. And if anyone, yep, go ahead.
We do have a question, and somebody's asking if you can talk about average return for investors over the past 10 years.
Yes, so this fund was launched in 2014. So, we're coming up, as of March of this year, will be our 8-year anniversary. And through that 8-year period, we've annualized a little over 12%. And this is something actually Frank and I were actually talking a little bit about in our last couple conversations, actually, as well as today. But again, access in the private markets looks a lot different, as I kind of touched on, than the public markets, meaning that someone with $10,000 can buy Tesla and Netflix, right? Common shares of Tesla and Netflix in the same capacity as a multi-billion-dollar institutional manager can buy common shares of Tesla and Netflix. However, $10,000 in the private markets, we wish that individual or that firm the best of luck, right? You're really not going to get any exposure, any access to private companies. Again, as I mentioned, really to get into a top tier private company, you need at least $10 million per transaction. So why I bring that up is that when this fund was launched, it was basically seeded with $100,000 in capital. So as you can imagine, it was difficult for us getting exposure into companies that maybe we would have wanted to. So it took a few years for the fund to kind of find its feet, if you will, with the understanding that we knew that as the fund continued to grow, and therefore we'd be able to cut a larger check, we would get into better companies. And I think that's really what you've started to see over the course of the last 3 years. And as a result, it's manifested in better returns. So what do we expect moving forward? What is our goal? And this kind of ties into why I think this fund really works well given the certain market environment. It's not only us believing that we can generate equity-like returns, if not better, but we're going to do so with a lot less volatility. This fund correlates to the public markets at about a 0.2 to about a 0.25, right? To the S&P and the NASDAQ, about a 0.21, to the Russell 2000 or small caps, about a 0.26. And so what we've been able to do is essentially generate equity-like returns with about a third of the volatility. I'm not sure how many familiar are with standard deviation. It's kind of the more accepted measurement of risk, but we've got about a third of the standard deviation of the Russell 2000. And so when I think in an environment where a lot of the conversations that I'm having with financial advisors such as Frank, who I think view the market in a very similar manner, is not to say that this market can't generate, a 10, 15, 20% this year, but the question is, how did you get there? And in a day like today, where the NASDAQ, I didn't see how we closed, so forgive me, but at one point today, the NASDAQ and the Russell were down 2 to 2.5%. Our thought is that, again, we can generate equity-like returns, but this fund is just going to give you a much smoother ride getting there. We're not calling this a core, we're just saying it's a sleeve to not only get you exposure to an asset class that perhaps really wasn't obtainable in the past, but also from a portfolio construction standpoint, really adds an uncorrelated return profile, an improved risk-adjusted return profile that I think adds value. So I hope that helps give you an idea of the historical returns, but why we think those returns can improve given the level of access that we are now getting because we can simply cut a larger check.
Good enough.
So, great. So a couple names that I will touch on. Of course, probably the most recognizable name in our portfolio is SpaceX, right? Of course, run by Elon Musk. It is now our second largest position. We got into SpaceX because of a relationship through a venture capital firm. And then now that being that we are invested on there, anytime SpaceX or any private company comes out and issues more equity, those who are already invested in that company have what's called rights of first refusal, right? We have the ability to add to that position. And so that's what we've been able to do. That's how we've been able to not only maintain our SpaceX weighting, right? We want to make sure that SpaceX continues to be, 5 or 6% weighting. So we continue to allocate more capital to that name. A company that maybe not everyone may be familiar with, but I bet you've supported it, is a company called Marqeta. And Marqeta is basically the payment solution software for the likes of Uber or Uber Eats or DoorDash. So if you've ever ordered an Uber and literally clicked request Uber X, when you put in your credit card information, that whole processing is Marqeta based, right? And so why I bring this up is, as you can see here, as of 9:30, it was a top holding in the fund. It was the third, and it was kind of the crown jewel in the fund because we bought into it in the summer of 2018 at about $1.40 a share. We bought a little over 1 million shares, and this summer, I should say this past summer in 2021, it IPO'd around $28 a share. Now, to temper expectations, not what we expect, of course, out of every single one of our holdings, but it can show you the value of getting into these companies well before, again, they go through an exit. Now, since this slide was created, we've started to unwind that position because it is a public name. And so again, we start to wind down those positions once they do become public. Another name you might be familiar with, maybe you've seen some ads for it, maybe you use it, maybe your kids use it, I know I'm a subscriber to it, is Masterclass. Masterclass is an education tech company, subscription-based platform, where they basically have industry experts come on and provide almost 1-hour tutorials, whether if it is business personnel, whether if it is athletes, whether if it is, you know, some of the world's top chefs. My wife and I actually watched one about 2-3 weeks ago. I like to cook, as does my wife, and Gordon Ramsay, if you're familiar with that name, basically did a 1-hour show in cooking some of his more well-known desired dishes, right? And so Masterclass, again, is one of the more difficult private companies to get into in today's environment. It's a very sought after company, and so we were very excited to add this company to the portfolio within the last quarter. And again, this is a name that I would argue a year ago, we would not have really probably been able to invest in this company because we couldn't cut maybe the $15 to $20 million check that perhaps it required. And the last name that I will touch on, and it's one that I think we're most excited about, you know, when you really talk about innovative and disruptive tech companies, is Relativity Space. And Relativity Space is our fourth aerospace investment. And this company can essentially take raw materials and in a matter of 60 days, 3D print functioning propulsion systems and functioning rockets at about a fraction of the cost and about 100 times fewer the parts. So if you think about the push towards, you know, privatizing aerospace, right? These guys are working with the likes already of SpaceX and Axiom Space. And of course, I'm sure you've seen the launches done by Jeff Bezos and Blue Origin or Richard Branson and Virgin Galactic. So the idea is not only about making aerospace more efficient, but even when they're in space and they're orbiting Earth, you know, they want to provide basically 3D printing capabilities so that if something malfunctions or breaks in orbit, instead of having to send up an additional rocket to provide, you know, that part, you know, at some point scale comes into play, but in some capacity, they can potentially manufacture that piece on board. So it takes me to my next slide. You know, here you go. Here are the sectors that we are allocated to. Again, this is by design. We are trying to build a very diversified basket of innovative, disruptive tech companies, right? Right now, we are in 88 companies right now across 17 different sectors. You know, I think going into this year, we had our eye on a few different sectors that we would like to continue building out exposure to, whether that's aerospace, whether that's cybersecurity. We just added Arctic Wolf, which is one of the leading innovative cybersecurity companies when it comes to cloud-based technology, right? And so, you know, with that, you know, I'll kind of, you know, summarize again. You know, when you think about this fund, I think there's two parts. The first part is, why should an investor be intrigued, or why should an investor be interested in accessing private companies? Again, deals with the idea that because companies are staying private for longer, a lot of the growth and returns that you could have participated in 10, 20 years ago in the public markets are taking place in the private markets. But maybe more importantly, and I think this is where, you know, Frank's discussion earlier about the current environment and discussion that I'm having on a daily basis is, given the difficulties surrounding, you know, the equity markets in conjunction with fixed income markets, you know, I think financial advisors are being forced to become a little bit more creative in the solutions that they are offering clients. And a lot of that solution is coming from alternatives. And so that's exactly what we look at this fund as, is kind of an equity alternative, a way to, again, deliver an uncorrelated return profile or just smooth out returns across a diversified portfolio. So with that, thank you. I appreciate, Frank, again, you invited me on. Yeah, any questions? Sure.
We have another question. Since the fund was started, have you had any companies that were added that did not survive?
Yes, we had one file for bankruptcy. And I think that, look, whenever you're talking about private equity, I certainly am not sitting here, nor is our team sitting here and saying that every single one's going to be a home run. But that company was towards the beginning of the fund. It was a company focused on solar energy. It was called Sungevity. And Sungevity basically had to file for bankruptcy because after an election, there was concerns that credit lines amongst some of these solar companies were going to be frozen. And solar companies are very capital intensive. And so their credit facilities were shut down. And in which case, without a credit line, they basically were forced to file for bankruptcy over about a quarter. So we did have to mark that position down. And that actually, if you're talking about drawdowns, that actually caused the fund's largest drawdown, which I think on a relative basis isn't bad, but I'll let you guys determine that for yourself, which is about 6% is this fund's largest drawdown. Outside of that, we have not. Now that doesn't mean that we have not had investments that didn't work out, but again, as far as bankruptcy goes, that is the only one.
We have another question. What are the steps to invest in this fund? Save that for me, and we will talk about that. You can certainly send me an email, and I will share with you how to go about doing that. Let me pull up something here to kind of help with that. I'm going to take back the presenter role, but don't go anywhere. Yeah,
please.
Stay where you are, Eric. I probably have a few more questions.
I'm here. I'm not going anywhere. Yeah.
Good. Give me 1 second. All right. Oh, need to. All right. I apologize. It is not letting me share my screen. I guess it is letting me share my camera, but it's not letting me share my screen. So here's what I'm going to say. In the interest of time, because we are a few minutes over here, and I try to be done by 6:30. What I would say is this: if what Eric has talked about really piques your interest, I know a couple of you it does. Let me know. Just send an email, and we will send you the information on this. We can do it electronically. We can do it through regular mail. And then also I can go over the charts with you to show you, because if I can show you this chart, I think it's a pretty impressive chart on both its growth and its stability, both through 2018 in the fourth quarter when the market was down, and then again through the pandemic. It didn't take nearly the hit. I know this won't mean quite as much to you, but the pandemic made the S&P 500 go down about 30, 35, 36%. How much did this fund go down during the same time, Eric, the A-share?
About 2.5%.
2.5% compared to the 30+% that the S&P went down. So from an investment viewpoint and a stability viewpoint, you'll be able to see from that chart that the growth was very good, that the stability was very good, and that as a piece of your total portfolio, it would have a lot of value. I wish I could pull up the circles again and show you how we divide it out by percentage. Unfortunately, for whatever reason, I can't do that. But what I would say is this, is that everything's frozen right now for some reason. My cursor's moving, but nothing else is. So what we've done is we've gone over the 2021, what's happened. We've kind of covered a lot of what we think 2022 is going to look like, and I feel very confident under current situations, things are going to be pretty good this year, another good year. As far as potential investment opportunities, Eric did a fantastic job of showing you another way to go ahead and make it so that you can have your portfolio growth. And it's one of those pieces where I identify that with business interests, it's a whole new sector we're trying to add as much as possible. And private shares looks like they brought a great piece to this discussion. So if you have questions, again, I apologize for the way this ended out here. This is the first time this has ever happened, but if you have questions, please feel free to email me. or share to tomorrow, let us know. We'll be happy to get information back to you. And we've got the upcoming investor update that'll actually be the third week in February. I'm actually out of the office on the second week, so it'll be the third week of February, and we'll be sending you details on that. Beyond that, I'm just going to have to figure out what's going on here so I can shut this down. But again, if you have any questions, please email us. Be happy to answer this for you. Eric, thank you so much for your time tonight.
Sure. Thank you, Frank. Appreciate it.
If you have questions, I'll forward them on to you as well. If I can't get to them, we'll make sure that we get answers for each.
Absolutely. Happy to help.
All right. Thank you so much. Sorry it was kind of weird like this, but hope you have a wonderful night, and I will look forward to talking to you all soon. And again, thank you, Eric, for joining us tonight.
Thank you, of course, Frank. Thank you.
Have a great evening, everybody.